Here we go, getting ready. Infrastructure in 3, 2, 1. Welcome. It's Mitch Goldberg. You're watching my live stream. Be the boss of your money. Thank you so much for joining me. We're going to have a good show today. I'm really excited about this because we get to do something I like to do on Tuesdays, an ETF inside view. There are a number of infrastructure ETFs in a number of ways to play this massive $1 trillion spending bill for infrastructure. Roads, bridges, tunnels, high-speed rail, water, high-speed internet, climate change, and other things. There's something in it for everyone. And man, oh man, what a job creator this is going to be. We're going to talk about this, quick update in the market, how things reacted to this infrastructure bill, what you could do to take advantage of it. Plus, there's always winners, but we have to talk about maybe some of the losers too. We've got a lot to cover. This is going to be a good show. This is the place you come to for personal finance. So here's the intro. Let me find the intro. Let's rock and roll. Okay, I've got it. I fixed the bug, so I'm on a new screen. Here we go. All right, we're back. In case you are just joining us now, you haven't missed anything yet. We're just getting started. I'm Mitch Goldberg. You're watching my post-market close. It's my live stream. I should say that more often. You're watching my post-market close live stream. Be the boss of your money so that you could be the boss of your money, so that you could take control of your money. This show is about personal finance, the economy, investing, so much more. We have a lot to cover today. While you're watching this, if you're watching this in the live stream, if you have any questions, hit me up. I love hearing from you. Certainly words of wisdom and words of encouragement are always appreciated. And if you're watching in the replay, thank you to you as well. I do realize that not everybody has time to watch this at 4:30 while it's live. So it's available on YouTube, Facebook, and LinkedIn. After that, immediately following, so you can watch it at your convenience. I know who typically watches my live stream, so thank you, Josh, Stacy, Phil, and there's quite a few other people out there who are part of my community. It means a lot to me that you chose to spend some of your time with me. Now let's talk about infrastructure. It's a $1 trillion package. Now, $1 trillion doesn't buy us as much as it used to. But nonetheless, it's a pretty massive one. And it's going to cover bridges, tunnels, roads, broadband, water, rail, climate change, maybe other goodies in there. You know, I was driving from Long Island to New Jersey, over bridges, through tunnels. And I've got to tell you, I'm actually the type of person, like when I'm underneath the bridge, I look at the bridge, I look at paint, I look at rivets, and I look for rust. And I could tell you in my neck of the woods, infrastructure is badly in need of repair. I mean, there are some columns that are so deteriorated in terms of the cement and the rust. I wonder how some of these bridges are still standing. So this is going to be a long-term deal. It's going to take a decade to push this whole thing out. I'm hearing 5 years. We'll see how long it takes. It takes a long time to get the money appropriated. The bill will probably wind its way through the House of Representatives mid next month. So we've got just about a month until it's finalized. But the deal is, it made it through the Senate with a vote of 69 yay, 30 nay. So I guess that leaves one person out. So it was a bipartisan bill. It's going to create a ton of jobs. Let's put aside the politics for a second. Red state, blue state, put this aside. There's going to be a lot of jobs created, which means there's going to be a lot of people spending money, buying stuff, paying sales tax, income tax. So maybe this won't be as expensive as you originally thought. It's going to create jobs in manufacturing, mining. It's really, this is like a really big, a really big deal. But the market didn't react huge to it. So let's take a quick look at how the market reacted, and we'll take a look at a couple of things. Who's out? Hey, Josh. Josh, did you hear? I just gave you a shout out a couple of minutes ago. Thank you very much. Really appreciate you joining me. So let's take a look at how the markets did. I'll pop myself up in the corner over here. That's not quite what I wanted to look at. Okay, so while I have you here, Coinbase just came out with quarterly numbers. This is their first quarterly report since going public. They beat earnings. Their earnings, which was not as bad as we thought, lost less money than expected. Revenues exceeded analyst expectations. The stock had a little bit of a pop in aftermarket trading. The news has been out, I would say, for close to a half an hour. It's only up 8 cents right now in aftermarket trading. A second ago, when I pulled up the screen, it was down. There it goes. It's down now. It was down over $10 in the regular trading session, aftermarket trading, not doing much of anything. I surmise it's because a lot of activity happened, but investors are worried about the number of transactions taking place, about the number of trades that take place on Coinbase. So, we've got to really keep a lot of excitement in crypto for Coinbase to keep going up. That's what I'm thinking, that investors may be thinking. Maybe it's as good as it gets. While we're checking that out, let's take a look at Robinhood. The symbol in Robinhood is hood. So if you like Robinhood, does it make you a hoodie? Does it make you a hoodlum? Just kidding. Okay. So let's take a look at Robinhood. I used that joke the other day. I know. Natalie's thinking while she's editing this the next morning, like, he just used that already. Damn, he's recycling stuff like a day later already. All right, I know. Listen, it's hard to come up with original, great jokes like I do every second, right? Okay, Robinhood, not really having much of any reaction to the Coinbase news. I think Robinhood, even though Robinhood is brand new to the market, literally for a week, but I could see Robinhood and Coinbase trading very similarly because they have a very similar base of clients. But you could trade crypto on Robinhood. I wonder, maybe their competitors, maybe Coinbase will get into trading stocks. Crazier things have happened. So no great shakes from Robinhood. Let's get rid of that. Let's see how the market did today. Let me make this a little bigger because this is like microscopic on your smartphone screen. All right, here we go. All right, so the Dow up 162 points, new record for the Dow. All right, way to go, Dow. So Dow up a new record. Nasdaq off a little bit. We're going to talk about exactly why. S&P up fractionally. The reason S&P was only up fractionally is because the big tech stocks just didn't work out today, and it's hard for the S&P to rise a lot without the participation of the top tech stocks. We'll go over that as well. Gold was up a little bit, but it's well below 1,800, where it's been trading for a long time. Gold is an inflation indicator, an inflation hedge. So as gold weakens, people start to think, maybe not so great for inflation. But with this infrastructure deal, we'll see. Maybe people are finally getting smart about gold and thinking there's no real use for gold except for some industrial electric components, maybe. Yeah, that's an important use, but not that much to move it, really, and jewelry. So maybe people are starting to realize that gold is just, it's a rare element. I get it. But as far as a store of value, I mean, it could go down by half and still be considered a store of value. All right, the 10-year Treasury, this is the story to me of the day, up to 1.35%. This was 1.13% a week ago. It was stuck in the 1.2 area, 1.25 for a while. Now it's at 1.35. So all of a sudden, interest rates are going up. Maybe we're not going into a recession. Yesterday I spoke about that the Treasury yield was going so low that people are starting to worry is the yield on the 10-year Treasury signaling a recession or deflation. What was going on with that? Okay. VIX is under 20. It's at 16. Like I said, if it stays over 20, gets above 20, we'd have a really down market. It got up to about high teens, but never really did anything. And as you can see, the market's holding up just fine. Let's take a look at the Russell 2000, up 4 points, up 0.2%. That's the Russell 2000 at 2239. Russell 2000 measures small cap stocks. That's the index, the premier index for small cap stocks. And what you need to know about that is small cap stocks are a better gauge of the U.S. economy than large cap stocks, because small cap stocks get more of their sales domestically. Okay, so let's go and check out some crypto. Crypto is a little weak today, but crypto has been on a tear for the last week or so. But Bitcoin off 1.5%, Ethereum off fractionally. Not a terrible day as far as crypto goes. Doge, the joke. I have to call Doge a joke. Maybe it'll go higher, but it started as a joke. I don't know what people see in it. I think, there are Bitcoins that are truly trading that have something that weren't started as a joke. There were Bitcoin. There were cryptos that were started as a real hedge against inflation, against too much dollar printing. But nothing to complain about crypto. It's been on a bit of a tear lately. We'll see how the whole thing, the Ethereum London split, we'll see how the Coinbase trading goes tomorrow, the Coinbase stock. This stuff is all becoming very related. Venmo, by the way, has a credit card, a cashback card. And Venmo said that instead of getting cash back, you could get crypto. It's indicative of more acceptance about crypto. I can't get away from it, right? That's what that is. So let's break out of the screen for a second. Okay, I'm back. By the way, while you're watching this, if you don't mind, give it a thumbs up or a heart. Give it a heart or an applause, depending on what platform, or celebration, depending on what platform you're watching on. This way, I get to see you. I get to see who reacts. If you have any questions about any of this stuff, definitely hit me up. This is the time to do it. I'm a financial advisor, 31 years in the business, coming up to 32 years in the business this winter. I know a lot. I've seen a lot. I've helped clients manage through all kinds of challenges. And what's really cool? I've learned a lot from clients, not just from helping them, but clients who have a lot of things to offer. I'm very fortunate like that. All of my clients has their own story, their own view of success, how they achieve success. And I learn from them too. And it's like, man, you put this all together, and I use all of this to help other clients. It just spirals in a good way. It's like an upward, line. I don't know. I don't know how to describe it, but I love it. It's my favorite part of the business. So let's talk about infrastructure stocks. So we're going to go to the watch list. Okay. So I'm gonna put you back on the screen. Something here. Watch this. Watch how I switch screens. Did that work? Hold on. All right. I messed up my screen. I hope you can still hear me. I'm up here. That is not cool. All right. I took myself out for a second. Wow. I don't know what happened, but my screen froze, and I thought I had all the bugs worked out, but apparently I didn't. I'm going to run out of the studio, and I'm going to come back. Don't go away. I'm going to be right back. I'm going to run out of the studio, and I'm going to come right. All right, I'm back. Probably lost all the viewers. Okay. I don't, look, this is live streaming. This isn't TV where it's perfect yet. I'm going through my own cameras right now, going through all kinds of adapters and converters. If you saw my whole office, there's like cables all over the place. I have them all pretty well managed. I hate when I hit the wire on my microphone right here. I have them all managed pretty well and, you know, all tied up together, but still that's the thing about live streaming. It's not quite prime time yet. So I'm going to try this one more time. Okay, let's see. The thing that caused the issue, I'm going to try that. Okay. No, it's still in a cut. Look at that. You see that? The screen moves. You see that? Watch this. Check this out. Oh, yeah. Look at that. Now I'm going to go back to the screen, pop myself up in the corner. All right. Let's go with the watch list. I first want to go into what worked. We'll take a top-down approach, and I'm going to give you the ideas that investors are looking at and what is the losers, okay? What are the losers? So let's first go with the sector ETFs, okay? This is for the day trading, not for day trading, for today's session of stock trading. XLE up 1.76%. XLE is the big ETF from the Spider ETF from State Street. It tracks the energy sector, okay? Tracks the energy sector. Up materials, as you'd expect, at 1.5%. XLF. Okay, remember I spoke about the 10-year Treasury yield going up? Good for the banks, good for financials. So XLF, the financial sector ETF, was up over 1%. Industrials up over 1%. Consumer staples up a little. Discretion. Overall, it would happen to have been a good day. But what were the losers? Technology, real estate. I think real estate just because it's so interest rate sensitive, and healthcare. Healthcare, I'm not really reading anything into it. It's just that maybe it's, you know, not as much, it doesn't garner as much investor interest, because when people think the economy is going to be booming, they would just, you know, healthcare is more of a sector for when you think the economy is kind of muddling along, a little slow or getting slower. You want to own healthcare, consumer staples, companies that make products that you need, not necessarily that you want. You know, like they call it toothpaste and toilet paper. Okay. So that's consumer staples. But healthcare, I don't read anything into it. The fact that wasn't a particularly good day for healthcare. Now, so industrials, you'd expect to go up. In energy, financials. So let's keep going with the watch list. Let's take a look at some of the industrials. Oshkosh makes like cement trucks. Okay. You know, WNC, that's Wabash. They make the the trailers that go back on the back of the tractors, so 18-wheeler trailers. Southwest up $1.40. I actually have to tell you that airlines have been really, really weak the last month and a half, 2 months, when the Delta variant started to become a news item, when it started to become, you know, the main variant in the United States of COVID. Because when the Delta variant spreads, people travel less. The airlines have all been saying, by the way, they haven't seen a dip in passengers yet. So if we haven't seen a dip in passengers yet, and some very smart people like Dr. Scott Gottlieb, who's on TV all the time, especially on CNBC, he says that he thinks we don't get a surge into the fall. He thinks we're going to get through the surge by the time we get into the fall. And based on some analysis of India and Great Britain, that they peaked after 45 to 55 days of Delta variant, and we're just about there. We could start seeing the case count going down. Remember, a lot more people have gotten vaccinated, and a lot more people have contracted COVID, which means the survivors build up an immunity. So we could see a real strong rebound in the airline stocks. The infrastructure helps because people have more money, they travel more, but the COVID looks like it might have run its course in terms of pounding the airline stocks. I'm telling you that because I'm looking at Southwest Airlines. I hope this is helping you guys. Let me know. I mean, if you look at Southwest Airlines, let's just take a look at the year to date. You see how much it's come down? You see how like it peaked in April and it just went from 60, almost 63 down to 51. It did touch the 40 twice, but that's a pretty big drop, for that stock in that short amount of time. Now, industrials are known to be volatile. They react pretty quickly to the ups and downs of the economy. So let's get back to the watch list. Let me just close some screens here. I think I'm using up a lot of bandwidth. Okay. And let's take a look at the FANG M stocks. This is why I said the S&P 500 didn't have such a great day. Remember, I started at the top of the show. The S&P 500, nothing special. It didn't get a lift like the Dow Jones Industrial Average did. The NASDAQ was down. This is why. Because these companies, the FANG M stocks, that's Facebook, Apple, Amazon, NVIDIA, Google, and Microsoft. I said NVIDIA, not Netflix. A lot of people think when I say FANG, I'm talking about Netflix. I took out Netflix and replaced it with NVIDIA a couple of weeks back. Did a video about that. It's on my YouTube channel, by the way. Client First Strategy. Go check it out on YouTube. Please subscribe while you're there. So Facebook off, NVIDIA off. They're all off. I mean, the whole sector. So these stocks are such a big part of the S&P 500 that when these go down, not only do they drag the NASDAQ down, the NASDAQ 100, they drag the S&P 500 down with them. That's why the S&P 500 couldn't get any lift. The Dow Jones is a little bit more sensitive to industrials and financials. All right. So now let's take a look at some of the ways. Well, remember I said I want to do winners and losers. Let's just do a quick thing regarding the losers. Who loses in an infrastructure plan like this? Now, this is just my very preliminary opinion. All right. It's just my opinion. Okay. I'm not necessarily your financial advisor while you're watching this. If you would like to make me your financial advisor, certainly reach out to me and we could speak about that and see if we're actually a good fit. But I'm also might not be, for a lot of you, I think for all of you really who are watching, I'm not your mama and I'm not your papa. And some of you who are watching, I am your financial advisor. Thank you so much. It means a lot to me. And we're going to keep on keeping on. All right. So the losers, if interest rates go up, I'm talking long-term interest rates on like the 10-year Treasury bond, the 30-year Treasury bond. When interest rates go higher, I think I need a whole screen for this. When interest rates go up, it makes the future expected earnings of tech stocks and of highly valued stocks, it makes their current earnings worth less. So those stocks get marked down in value. So companies that aren't making a lot of money, for example, right now, but they're expected to make a lot of money in the future, when interest rates go up, all of a sudden that money, that big amount of money in the future, it's not worth as much anymore if long-term interest rates go up. Now, if you take companies like Google and Amazon and Microsoft, they make a ton of money. They're doing incredibly well. Just it's like an economic miracle. It is an economic miracle how they're doing. In fact, Warren Buffett called Amazon an economic miracle. But these companies do become richly valued because they're perceived so well by investors. They become so, what's the word I'm looking for? I don't want to say over-owned, but they're definitely widely held. Yeah, that's the right phrase, widely held. So maybe their valuations are a little higher, so maybe their future expected earnings get marked down a little bit too. Hence, there was no interest in these stocks today, and these stocks all backed off a little bit. It wasn't a disaster. Now, the industrials, materials, they didn't go up flying either today because I think we all saw that this infrastructure deal was going to be a done deal, that the Senate was moving it along and they were going to pass it. And I'm sure the House will pass it. I really not worried about that, in my opinion, at all. So those are the losers, is the work from home, stay at home stocks and companies that would do a little bit worse if interest rates go up in terms of stock performance. So the beneficiaries are industrials, materials, and financials. You could break that down further into steel stocks, lumber, employment firms, any materials company really. So that's where those are the kind of sectors that should see a positive gain, positive momentum from the infrastructure deal. It doesn't mean the prices of the stocks reflect it, but it's good for the fortunes of these companies, which I believe will ultimately become good for the stocks. Okay. So let's go take a look at the infrastructure plays. Okay. Oddly enough, I have a new watch list, a new list on my watch list. And oddly enough, pop myself up on the screen. It's called the infrastructure list. XLB is the ETF that tracks building materials. It was up 1.5% today. XLI is the big ETF. We just looked at these a few minutes ago, by the way, that tracks industrials. IFRA, that's the iShares US Infrastructure ETF. That was up 1.45%. And PAVE, the Global X US Infrastructure Development ETF, was up 2.19%. So if you put these in order, okay, PAVE was the big winner, and that's because it has a very large component of steel stocks, and steel stocks like Nucor were the standout winners. So let's take a look at like Nucor. Okay, let's just take a look at that. Nucor was up $10 during the regular session, and that's a big position in that other ETF I just showed you. We're going to go through these ETFs real quick, one at a time. I want to show you what I'm looking at. Make sure the screen can keep up with me, and I want to make this a little bigger before I show it to you. All right. All right. So let's see if we could show you the screen there. All right, here we go. Oh, man, I love when the technology works. Okay. So XLB is the big materials tracking ETF. It tracks materials stocks. Okay. I'm not going to show you every little thing. But year to date, it's clearly up from about, from 72 on the close of last year to almost 85. Not a bad place to be. Okay. Year to date, up 15.31%. Not a bad place to be. I don't want to get into all the performance figures. You can look at them there. But let's take a look. It's US centric. It's commodities, 47% of the fund, but Lind 16%. So there's the top holding is 16% of the portfolio. That is a lot. So that's a pretty top heavy investment fund. Okay. Sherwin-Williams, Air Products, Ecolab. Ecolab is in energy. Freeport-McMoRan, Newmont Mining, Dow Chemical, DuPont, PPG Industries, and International Flavors and Fragrances. Why is that stock in this? International Flavors and Fragrances? I'm not really sure. Well, it's a materials company. I mean, it's not infrastructure materials. I don't think anybody's trying to make a highway smell like, vanilla or something, but that's what it is. Okay. Look, I didn't create it. Okay. So let's go to the next one. XLI is the big ETF that tracks industrials. We went over this. Let's just take a look at what is in this one. Okay. Did I go through this too quick? XLI ratings, reports, and holdings. Hopefully this doesn't take too long. Here we go. It's important to know where your money's going. And this one here, the year-to-date chart is about 75 to 100. So this has been a big winner already this year. So look, there aren't any cheap stocks. One of the reasons this is up a lot is not just because expected infrastructure spending. If you think about it, originally late last year and early this year, we were talking about maybe a $2 to $2.5 trillion infrastructure bill. So this one's $1 trillion, a lot smaller than expected. But this one that we got today does include entirely actually what you would consider traditional infrastructure. Okay, roads, bridges, tunnels, that sort of thing. All right, who's in it? Honeywell, these are, I don't think you could find anything to knock here. Honeywell, Union Pacific, UPS, Raytheon, Boeing, 3M, GE, Caterpillar, John Deere, and Lockheed Martin. These are industrial companies, okay? And if you think about it, if any of these companies were missing, that would be a major change to the economy. You think about how big UPS is. Can you imagine if all of a sudden one day UPS stopped running? I mean, the whole world would stop. Like literally, that's how big they are. So that is the other ETF. Now I want to take a look at IFRA. That's the iShares Infrastructure ETF. This is a little different. I think over the expense ratios of the other funds, but they are rock bottom. But this one has Sonova, Middlesex Water, NRG, American States. Maybe if I make this a little smaller, I'll be able to see the names a little better. Nah, it didn't matter. Okay, forget that. Forget about it. All right. NRG, American States, California Water, American Water, NextEra, SJW, Chesapeake Utilities. I would expect utilities to be in a utilities fund, not an infrastructure fund. Otter Tail. Out of all these companies, I've heard of maybe 4 or 5 of them of these 10. So they're not the most widely held ones that I've ever seen. Let's see how it's done this year, though. It's gone from about 25 to 35. It's up. It's been up a lot. This has been the biggest winner so far this year. And let's take a look at the last one, PAVE. This is the Global ex-U.S. Infrastructure Development Fund. I think this one is really leveraged more to the economy, but this has gone from 16 or so to 26, so not too dissimilar from the other one. But I want to look at the expense ratio in this one is 0.47%. I'll tell you the others also. I don't think the expense ratio is going to be the end all and be all when you get into a sector. It's nothing crazy. Once you get to like 1.5%, then I think you're kind of getting crazy. It's 99 holdings, so it's pretty diversified. But Nucor, that's why this one was up the most today, by the way. Nucor, Train Technologies, nothing runs like a train. Eaton, Emerson, Deere, Rockwell Automation, Fastenal, Vulcan Materials, Parker Hannifin, Kansas City Southern. Kansas City Southern transports a lot of coal and iron ore, things like that. So these are the ETFs that people are going to use to play this sector. I don't want to tell you, still with me. Thank you very much, by the way, Josh. Really appreciate that. I don't want to tell anybody which one, let me go back to that. I would tell you which one, but I don't want to say it into a live stream. But as far as playing infrastructure or overweighting your portfolio for the infrastructure economic reopening, and what this does, what the infrastructure bill that just passed the Senate really does is not necessarily give a major pop to infrastructure and economically related type stocks. These stocks have already moved up in advance on anticipation of this bill successfully moving through the Senate. But it does, to me, in my opinion, it does appear that it should keep the performance going. It aids the reflation trade. It aids the higher interest rate story, which could be good for the banks as well as other economically sensitive stocks. So overall, I think it's a good thing, and I think it takes away some of the fear of the Delta COVID variant slowing down the economy too much. And instead of thinking that we are past the peak of growth for the economic recovery, maybe it'll change the thought process for investors, and I think rightfully so, to more of a sustainable high plateau as opposed to an inverted V that shoots up one side and shoots down the other side. Okay, so that's my story. I'm sticking to it. I appreciate you watching. We're up to 35 minutes. The time flies. I'll be back tomorrow. Thank you so much. If you have any questions, hit me up. And if there's a topic that you want me to cover, question you have about personal finance, investing, retirement, planning, inflation, whatever, let me know. I'd love to address that in an upcoming episode. Thank you.